Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to Better System Trader. This is episode number 140 and yes, we're back. For those who didn't see my email last week, we missed a podcast episode because I was in hospital. However, I'm back now and recovering nicely, so we're getting back into the swing of things and the podcast episodes will be resuming. A big thanks to everyone who sent me well wishes. I received loads of emails, most of which I haven't even replied to yet, but thanks to everyone who did email me. I really do appreciate it. In this podcast episode, we're going to be talking about something that can have a huge impact on the markets and on trading strategies. It's something that can happen very quickly and cause a lot of damage too, and that is spikes in volatility. And our special guest to discuss volatility spikes today is Andrew Thrasher, who published a research paper called Forecasting a Volatility Tsunami, which won the Charles Dow Award in 2017. Now, whenever the VIX is at low levels, we hear all about it in the mainstream media with the implication that it's about to rise. However, a low level in the VIX alone doesn't necessarily mean volatility is going to increase. So in our chat today, Andrew is going to explain why, and he's also going to share his research, including the 3 key factors that can actually improve predictions of volatility spikes. So let's get started and head over to my chat with Andrew Thrasher. Hi, Andrew. Thanks a lot for joining us today. It's great to have you here.
I appreciate having me on. I've been a listener of your podcast for a little while now, so it's a great honor to be on this side of it, to be a guest on your show. Thank you.
Awesome. I'm really excited to have a chat to you about some of the stuff we're going to cover today, so I think a lot of people are going to enjoy it. But just before we get into that, how about you give us a little bit of background on yourself, how you got started in the markets?
Sure. So I've been involved in some form or fashion with the financial markets for the past about 9 years, almost 10 years, primarily on the money management side, working for registered investment advisors, wealth advisors, working on the portfolio management teams. I started out as just an analyst right out of college. I got a degree in financial planning, worked for a financial planning firm in Florida. And then for the last about 6 years, I've been with my current firm in Indianapolis, Indiana, as a portfolio manager, managing assets for high net worth families and a couple different corporate pension plans, but using primarily individual stocks and ETFs.
Yeah. Okay, cool. Well, I originally discovered you because you wrote a paper that actually won the Charles Dow Award. So congratulations for doing that. Do you just want to give us a little bit of an introduction on what the paper is about and the background around why you decided that you'd write that paper?
Sure. So my paper was called Forecasting a Volatility Tsunami. And it really came from my research that I was doing for the assets that I was managing within my firm's portfolios on downside risk. Obviously, those of us in the markets are always focused on protecting from the downside, trying to limit drawdowns as much as possible. And so I've been doing a lot of different research on volatility and trying to come up with just, is there any commonality in the volatility market to when it has these big spikes higher? So just parsing through different pieces of data, I found that this dispersion, which is what I write about the paper, I'm sure we'll probably get into, the dispersion and the volatility index got really narrow before a lot of the big spikes. So something that I started kind of going down the rabbit hole of and eventually ended up writing the paper on it. It was a great surprise to find out last year, about January, February, March time, that I won the Charles Dow Award. It's a huge honor. There's some very distinguished past winners that I've looked up to a lot, read their books from some of them, and so it was a huge honor to win the Dow Award. But the focus of the paper was trying to forecast spikes within the volatility market.
It's quite an interesting title as well. I think the word volatility tsunami kind of brings up images in the head. How did you come up with that title?
It was about halfway through of writing the paper, and the commonality that I was kind of connecting to a tsunami is before a lot of different storms, earthquakes, and tsunamis and things like that, floods, that there's kind of this calm before the storm to where weather can get really just almost kind of like the eye of a hurricane where it gets really calm. And similar to before, tsunamis often where the water becomes very, the waves die down and it just becomes, like I said, just very, very calm. And that's what I attribute to the volatility market before these spikes, that we see the volatility becomes the trading, the day-to-day movement becomes very, very narrow. It becomes very calm. And so I attribute kind of the tsunami being the spikes in volatility, and the calmness is kind of what precedes that. And that's what the paper really discusses, is that really tight dispersion, that really calm market behavior before we see these sometimes violent spikes higher.
Yeah, and with a tsunami, you find that the water kind of gets sucked back into the ocean, doesn't it? It gets pulled right back before
it's amazing when you see pictures or video of it, what can happen before those massive storms.
Yeah, and it can bring a lot of destruction as well. So I'm looking forward to hearing more about how that ties into volatility as we dig a little bit deeper. Now, can you, before we go more into your research, can you kind of explain how volatility is usually interpreted or used by practitioners these days?
Sure. So volatility is typically, it's often called the fear index because of its negative correlation to the equity market. So it measures the forward-looking, so that when we talk about volatility, we're often talking about spot volatility, or the VIX, which is looking at the forward 30-day price movement within the S&P 500. And so while the VIX is negatively correlated to the S&P, it's not necessarily just looking at downside price movement. So if the VIX is trading at 14, that's projecting that there's an annualized 14% move over the next 13 day annualized move. But that could be either up or down. Here recently, I know this will air probably a couple weeks later, but we've seen a high correlation in the S&P and the VIX as they've both been rising. And so that can happen fairly regularly, where we see the volatility market, volatility index, and the equity market rise together. And so what the volatility is often used within the options market. It's based on the options activity of the S&P 500. Originally, it was the S&P 100, but it's not a tradable asset. It is an index. It's not like an ETF, or there's ETFs based on it, but it's not something that can be traded directly. So it's a market gauge, a way for us to understand what's going on from the option standpoint within the S&P.
Yeah. So I think when you have extended periods where the VIX is low, there's there's a lot of noise about it in the media, and the implication is that the VIX is going to jump and it's going to have some kind of impacts on the market. Now, anyone who's read your paper would know that there's a bit more to it than that. But when the VIX is low, is there any negative implications while it is actually low?
I think 2017 is a great year. It's kind of ironic that my paper won in early 2017, when, as we just saw, it was one of the lowest volatility years in market history. And so it's kind of a great example that low volatility doesn't necessarily precede high volatility. And that is one of the topics that I get into in my paper, showing that just because volatility is low doesn't necessarily mean that we're going to then have a big spike higher. You're absolutely right that the media does push that theme, that when the VIX is at 14 or 10 or 9 or what have you, is very much below the average of being 20, and they say it's going to have some mean reversion. But that while it often will eventually rise back up, it doesn't necessarily. It's not a great predictor of rising volatility.
Yeah. So before we get a little bit more into that prediction, can you just define what is a volatility spike? Like, are you able to quantify that somehow?
There's not. I don't believe an industry standard of what a spike is. In my paper, I describe a spike as being a 30% increase in volatility. So that's kind of early in the paper. I define that as what I define as a spike. I'm sure other people maybe would use a different definition, but for my paper, I'd say just a 30%. And there's not a main reason why 30%. I found that there's been quite a few 30% spikes in volatility, so it gave a decent sample size to test upon. But it just need to find some type of benchmark, some type of a reference point, to then find what led to those 30% moves.
Yeah.
So I use 30%. Others may say it's 50%, or a lot of people don't like referencing percentages in the VIX because it's really the point moves more so than the percentage moves. But I use 30.
Yeah, well, there's other ways to measure it. I guess you could look at volatility or standard deviation and things like that. So, did you find that a percentage worked better than others? Did you do any comparison or not?
What I was looking for was less so what the actual spike was. What I wanted to find was, again, wanting to keep the sample size large, so I had a lot of data to work with, and found that throughout different market cycles, we've had quite a few 30% moves within just a couple. I defined it, I believe, as a 2-week period, where from the low to the high rose 30% within about 2 weeks. And we've seen that in up cycles and down cycles and flat periods. There isn't really it doesn't form fit to just one type of market environment. And so that's why I was sticking with the 30%, and then kind of going from there to see what commonalities led to these large spikes higher. I often also use 30%, and there's a chart in the paper that shows an example of all the 30% spikes, that a lot of the spikes did peak out around the 30% mark. So just actually that was by chance. Once I started plotting it and getting the data ready for the paper, noticing that a lot of the spikes did begin to fizzle out once they got to that 30% mark.
Yeah. Now you've just mentioned that the absolute level, or just because the VIX is low, doesn't necessarily predict that there's going to be a spike. I guess the challenge around that is knowing when it's going to happen and how severe it's going to be. But what other factors did you look at to kind of try and improve the predictability of VIX changes in the VIX?
Sure. So there's 3 that I looked at in the paper, and one is the 2 that I believe are less effective, and one that I believe is much more effective. So the 2 that I showed in the paper that I believe are less effective is, one, just the VIX being low. So I look, and then also looking at large declines in the VIX. So whenever the VIX has large drops, so whether that would be like we said, a spike was 30% higher. What about when it had large moves very quickly? Because there's a great belief that volatility mean reverts. So if it had a large drop, then maybe that means it will be followed by a large spike. And I showed in the paper that just wasn't the case. I did some regression analysis and plotted that. At least I believe I showed in the paper the one for the 3-week for when the VIX is low, and showed that the resulting 3-week max increase in the volatility going forward is all over the place. That you could see volatility get to be 150% higher in 3 weeks from the VIX being above 30, or it could be 10 or 11. That there really wasn't a good clustering of data that showed any type of commonality or predictability of the VIX moving higher just because it was low. Whereas the piece of data that I found that I believe is a good predictor for volatility, for spikes in volatility, is that low dispersion. So dispersion meaning that the standard deviation became very, very low, very tight. And I show the scatter plot of that in the paper as well, where a lot of the largest spikes in volatility over a 3-week time period all occurred around a very, very low level of dispersion, a very low level of standard deviation.
So are you saying there that you want the VIX to be low, and then you also want the dispersion to be low at the same time, or can you have a higher VIX and a lower dispersion, which also can trigger a spike?
I believe you can pair them together. And oftentimes the dispersion is low when the VIX is quote unquote low, but it's also defining what's considered a low VIX. Coming into 2017, oftentimes people were saying that you would have thought a 10 or 11 or a 15 was considered low for volatility. Throughout this past year, we were seeing volatilities in the single digits. And so it's all relative of what VIX is considered low. So by putting a more formalized process of looking at the standard deviation of volatility, which is what I did in the paper, is able to compare different market environments, whether the VIX is trading at a 12 or VIX is trading at a 20, because we've seen spikes occur from all different types of levels. It doesn't just have to be at a very low, however you define that point. So I'm more concerned with the dispersion, the standard deviation of the VIX, more so than what the absolute level that it's trading at.
Yeah. So I think you just mentioned perhaps it was a 3 or 4 week look back for that dispersion. How did you come to that look back period, and what kind of differences does switching the look back period have on the predictability?
Sure. So the standard deviation look back period that I used for the paper was 20 days. Really wanting to stay away from any type of optimization, I used 20 days just because that was the period that for when John Bollinger came with the Bollinger Bands, look back period for that was 20 days. So kind of sticking. Sorry, my dog's getting a little bark, starting to bark a little bit. That's why I stuck with that 20-day period. It could definitely be optimized for kind of different risk tolerances and time frames to shorten or lengthen the look back. But the purpose of the paper was more so to show that dispersion was a good predictor, less so to create the best trading signal, so to speak.
Yeah. And did you find any link between the size of the dispersion and the size of the spike?
I didn't. That's not something that I had dug into. But that definitely would be something, a good thing to look at going forward.
Yeah. Okay. And I guess if you think about the nature of the spike, what you'll often see is that it spikes up really quickly, and then it takes a little bit of time to reduce. It kind of ticks on a lower. What does this type of behaviour have on stock prices when it's kind of? I'm trying to think of the word, and I'm drawing a blank in my mind, but I guess it's kind of skewed. It spikes up quick and then tapers off slowly.
Yeah, that's something that I did. There's been research done that does show historically VIX moves much faster on the way up than it does on the way down. The same for stocks is that stocks take the escalator up and take the escalator up and the elevator down, and the volatility market does the exact opposite. And so I think that's what's more important in being able to kind of know when we're in these periods of times where volatility can spike higher, because it can happen overnight. It can happen very, very quickly. And so that's what I show, that because oftentimes before we see these, as I define, 30% spikes, almost all of them, not 100%, because nothing's perfect within the market, but a lot of them are preceded by very, very low dispersions. And just for some examples, before the 2015 spikes, before the flash crash in 2010, we actually saw the dispersion get very, very low for several weeks. Before the financial crisis in 2008, dispersion got very low before the VIX went from being under 20 to 80. And in fact, the CBOE has recreated the data going back to show what the VIX would have looked like during the Black Monday and during the 1987 crash. And so I've applied the same type of looking at the standard deviation of that data. And even before the 1987 crash, we did see a very tight dispersion, a very low standard deviation within the volatility index. So by looking at this type of data, it's not meant to be a trade signal by itself. I use it alongside a lot of other pieces of data, but by itself, it does show that there's a window opening for the possibility of the VIX to spike. And we did see that before the 1987 crash.
Yeah, I guess as well, some traders like to try and pick the top of the spike and trade from there. Is there any way to kind of tell you've hit the top of the spike until while it's happening, or is there any kind of clues that you can look out for?
There's a lot. You're right. There's lots of different. A lot of people try to find that the top of volatility. It can be a very dangerous game.
Yes.
As the '87 crash is probably a great example of that, or '08. Oftentimes, people a lot of traders will use the VIX curve, and so they'll look for when it shifts from contango to backwardation, meaning that the front month becomes more has a higher premium than the later dated, the second month or third month. So when that moves into backwardation, that the options market's telling us that they're pricing in a higher level of fear, so to speak, for the current market than they're expecting in the future. So some traders look for that. They look for backwardation to occur because that will often be worked out. But the market can stay in a backwardation state for several days or several weeks. So there's not a perfect way to do that. Others will use just traditional technical analysis for mean reversion. But there's nothing that I've seen that works perfectly all the time to get the top. Because it does, like we said earlier, it moves much faster on its way up than its way down. There isn't really, in my opinion, a need to get the very top of volatility because it often will stair step its way back down, allowing maybe some better, from a risk reward perspective, entries if you're trying to catch the downside move of the volatility index.
Yeah. Yeah. So once we've got this compression, we've got the lower VIX and the dispersion kind of indicating something could be on the horizon. Is there any other warning signs that you can think of for perhaps heightened risk of elevated volatility, or any particular catalysts that you've seen that can kind of trigger that?
There are. This is, like I said. I have a volatility model that I use to forecast these spikes. Piece of it is this dispersion that my paper's on, and then there's a whole host of other pieces of data that I use. Unfortunately, not going to be able to get into everything that goes into it.
Yeah, sure.
There is. I've seen some other research done that shows a correlation to the yield curve. That the steepness of the yield curve can have implications on the volatility market. I believe it was the CME group, or actually it might have been the Fed, that put out an interesting paper looking at the correlation of the yield curve to the VIX.
Yeah. Okay, so let's talk a little bit about protection now. How can traders or investors kind of get themselves prepared in the calm before the storm?
Sure. So it all kind of goes back to everyone's individual risk tolerance and kind of how they trade. If it's somebody who's more long-term focused, then the ebbs and flows of the everyday market might not be a big concern to them. For me personally, I don't plan on retiring for a good while. I'm still pretty young, so I'm not real concerned with 5-10% corrections in the equity market because I still have another 30-40 years before I'm going to retire. So I think it really depends on everyone's risk tolerance. But if someone really is trying to create a protection, they can use options, they can use different exchange traded funds or fixed income. It just kind of really depends on their own risk tolerance.
Yeah.
That's a harder one to answer in a broad term.
Yeah, sure. It's interesting there that you mentioned 5 to 10% correction, because I don't think we've had one for quite a while. I'm not sure what the stats are.
It has been quite a while. I forget what they look like, and it's interesting that the day that we're recording this, we did see a slight up move in volatility, and just because that recency bias of lack of volatility, now anytime we see a down move in stocks, even if it is just a couple basis points, we have less than 0.5% down today, and people were still panicking, and you start seeing the breaking news headlines on the financial news. It just people are so much more ultra sensitive to it after 2017.
Yeah, sure. You actually posted some interesting research on your website about the state of the markets today. There's we're breaking records in some areas, and you had a lot of interesting ideas or insights on there. Can you just share a few of those interesting scenarios that we're seeing in the markets right now?
Sure. So you were speaking to kind of my year in review. Is that what you're?
Yep. Yeah. And there was one after that as well, I think.
Yeah, so one of the things that I think that struck a lot of traders is the fact that 2017, from a total return perspective, was the first year in market history that every single month was positive. Just really shows the lack of drawdown. If we were to then look at like the Dow Jones, if you Dana Lyons put together a great piece of data that showed the cumulative losses for all the days in the Dow going back to 1915, and 2017 actually saw the lowest level of cumulative loss for any year going back to 1915.
Wow.
The CBOE has put out a great set of data showing that it was the lowest average level of the VIX, going back as far as it's a much shorter period of data since the VIX was started in the 90s. But just everywhere you look, we saw just very, very tepid markets. And so a lot of money was able to be made, fortunately, because of the strong equity up moves. But it was definitely a year for the record books.
Yeah, it's going to be interesting to see how this all plays out because we're in uncharted territory now. So it'll be interesting to see what the year holds for us ahead.
Yeah, very much so.
Yeah,
definitely looking forward to it.
I'm going to, if you don't mind, I'm going to link to that blog post, or I'll link to your website as well. But just so that people can have a look on there, because you cover a lot of other interesting things about internals, and I think there was some stuff about distance from moving averages and all those kind of things. I think it's interesting, and people can get a lot of ideas just by looking at that type of research. So.
Yeah. The distance from moving average is that's one I posted this week that I thought was really interesting. That we're the furthest we've been from the 50-day moving average, the 200-day moving average, and like the 1 year moving average. It's only been a handful of times that we've really been this far above those long-term moving averages, just to show the level of strength that equities have seen. It's quite impressive.
Yeah, it's pretty incredible. Yeah. Okay, cool. All right. Thanks, Andrew. Well, I might just start wrapping up now with some quick closing questions.
Sure.
Okay, number one, what's the biggest lesson you've learned through trading?
The biggest lesson I've learned is less so from the volatility standpoint, more from the individual stocks that I trade. And it's really to have patience and to have a process and to be able to follow it, and to really develop a process to trade that can be adaptive to different market environments. Like I said, 2017 was a pretty unique year. And so if the only way that you view the markets is maybe from mean reversion, waiting to buy pullbacks, that can be a pretty frustrating time. And so really having different tools in your arsenal and in your toolbox to trade different market environments was a great lesson, especially learned last year.
Yeah. And so how did this, the research that you did into volatility for this paper, how's that kind of impacted the way you focus your approach now?
Sure. It's definitely, within our firm, we're always looking for ways to manage risk. And so the research that I've done on volatility and continue to do on volatility, as well as other ways to manage individual stock risk, we really wanted just to minimize as much drawdown as we can. So we've utilized a lot of these tools to help manage the portfolios for our clients.
Yeah. Okay, cool. What about what is the best trading advice you've ever received?
The best trading advice I've ever received is really and it's cliche, and it's probably something that a lot of people say, is just to be as non-emotional as possible towards your portfolio. With the prevalence of social media, you can find someone that agrees with you just about anywhere, and so, or someone that disagrees with you. So really not allowing your emotions to be swayed from the news or from a blog post you read or a tweet that you read, but to really just follow your process and to not allow the emotions of everyday markets and market commentary to impact that.
Yeah. Okay. Cool. What's your favorite trading book or books?
Probably the couple of books that I've really enjoyed, and I know these get mentioned sometimes on your show before, is the Stock Market Wizards books by Schwager. Really enjoyed those. I've read a couple of those several times. Really enjoyed from a technical analysis perspective, since I am a CMT. One of my favorite technical analysis books is actually by Constance Brown, called Technical Analysis for the Trading Professional. I really enjoyed her book. I do a lot of momentum type trading. So I really have liked Mark Minarbi's Think and Trade Like a Champion, and then one book that is more of a fun read that came out I think last year, was called Black Edge. That was looking at the Stephen Cohen insider trading. That was a really eye-opening book, but it was a really well-written and a good read for more pleasure type reading.
Okay, I haven't heard of that one, so I'll have to go and buy that.
Yeah, it's definitely worth checking out.
Yeah, cool. All right, and what's the best way for listeners to get in touch with you or to learn more from you?
My blog is, and my website's athrasher.com. I'm also really active on social media, on Twitter at Andrew Thrasher, as well as stock twits at Andrew Thrasher. So those are probably the two best ways. Then my firm is Financial Enhancement Group. And so our website's yourlifeafterwork.com. But through athrasher.com, my blog, or from social media is probably the best way to reach out.
Okay, cool. I'll link to all those from the show notes page of my website so that people can find those easily. All right, well, thanks a lot for your time today, Andrew. It's been really great talking to you about volatility and the research and the insights that you found by
pleasure.
Digging into that. Is there anything else that you'd like to mention before we wrap up for today?
I think that best covers it.
All right, excellent. Well, yeah, thanks again for joining us and spending time with us, and it was really great chatting to you. So I wish you all the best.
Thank you, Andrew.
Cheers. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.